Welcome back. Earlier today was reported the ADP private payrolls added 164,000 in December, beating expectations. That is reported by CNBC. Now, the ADP National Employment Report tracks economic data on the level of non-farm private employment in the U.S. Private payrolls increased by 164,000. That was better than the prior month's 101, beating estimates of 130. What we're going to see in just a moment, ADP does show strength in hospitality construction, but manufacturing continues to decline on several measures now, and we see now several reports showing weakening economic trends. Well, first off, ADP non-farm private payrolls, 164,000 was today's number. Certainly better than the prior month of 101, but what we can see, this is one of the lowest numbers we've seen in quite a while. We'd like to see these numbers improve. So far, we have failed to even surpass the highs of August of 180,000. Now, here's the monthly change, and it's broken down by subsector. The headline report is 164,000. It's non-farm private payrolls. Now, then we have trade transportation up 15,000 jobs, 18,000 for financial activities. Education health services up 42. The biggest decline is in manufacturing. Not a big surprise. We do see 24,000 additional jobs in the construction industry and hospitality. One of the bright spots, 59,000 to the upside. That's on a monthly change. Now, on a month over month basis, comparing it to the prior month on a percentage basis, this is a little bit more telling. In particular, take a look, construction of 0.31%. That's only in 1 month. That's not bad at all. Hospitality up 0.35%, manufacturing down 0.1. So certainly a month over month basis, we're seeing a divergence in these trends. Here's year over year. Mining up 22%, strongest sector by far. Construction's up 4.9, hospitality 8.0, manufacturing down 1.6. We're starting to see a trend here. Now, we're seeing a strength in the construction sector by far, but again, manufacturing is still a problem. This is today's report. ADP, manufacturing in negative territory, construction in positive territory. But take a look at it from an historical point of view. The blue line's hospitality. That was strong today, of course. Purple line's construction, manufacturing in yellow. And we saw a crossover April of last year. We're continuing to see more and more strength in the construction industry and a lot more weakness in the manufacturing. They're moving in opposite directions. Now, yesterday we spoke about the JOLTS report, the Job Openings and Labor Turnover Survey. It's a different type of jobs number. What did that show us? Construction year over year up 32%. Non-durable goods manufacturing down 47%. Sounds very familiar to today's ADP report. Construction up, manufacturing down. Well, this is the construction spending number we saw a couple days ago. Remember, 59% actually was the strongest part of this report. But what we see, and this is specifically the manufacturing segment of construction spending, it's the lowest low we've seen all year, over the past year, even actually more than that. So we're seeing multiple different reports telling us manufacturing is very much in trouble. Now, the JOLTS and ADP report both show signs of economic decline overall, not only in manufacturing. This is a JOLTS report from the other day. This is reported obviously in thousands. We had 8.79 million. That was a report released just the other day. Lowest low. Take a look at the long-term trend to the downside in job openings. It's declining. That's the JOLTS report. This is today's ADP non-farm payroll. 164. Well, CNBC says that's a good number. It certainly is an improvement from November, but again, long-term trend, very much to the downside. So we're seeing multiple different reports tell us the same story over here. ADP, again, is showing strength in hospitality and construction. Hospitality, I think, is a new development this month. Manufacturing, unfortunately, continues to decline on several measures now, and there are numerous reports showing weakening economic trends overall. Just a reminder, please visit our Twitter, Just the Data. It's our daily technical trading journal where we show developments in different trends. This main page shows us the daily range. So the Dow Jones Industrial Average, S&P 500, NASDAQ, and Russell 2000 closed right off the lows of the day. If it said 100%, it would have closed at the high of the day. Now we're seeing this weakness extend to the 5-day ranges. We're really on the low of the past week or so in terms of the equity markets. But conversely, take a look at crude oil, 68% of the daily range. 5-day range is 70%, bucking the long-term trend to the downside. So crude oil looks like it's reversing off the bottom. These are just some of the ideas that we come up with on a daily basis. And again, we post these on our Twitter page. So here's crude oil, long-term trend to the downside. The red line's a 20 simple moving average. Okay, long-term trend to the downside. Well, this is confirmed by the two ETFs, XES and XOP, both centered around the oil and gas industry, and oil services industry, bucking the trend of most of the other sectors in the S&P 500 on a 30-day basis. They're still positive. Oil is the weak spot. So please visit us at our Twitter page, Just the Data, where we post these ideas throughout the day. And we really try to find new trends, breakouts, reversals, things of that nature. We hope this has been helpful. We look forward to seeing you back soon.